Welcome to this discussion today on Roth IRA conversion planning. My name is Robert Martin. I'm a managing partner here at Zenith Retirement Planning, and I'm also a chartered financial consultant. Now, what is a Roth IRA conversion? Well, a lot of families today are getting pretty obsessed with transferring money from their IRA, which is tax deferred, to a Roth IRA, which is tax free, which is different than a Roth IRA contribution, which is what you're doing while you're working. This is different than that. Ultimately, an IRA or 401k, a tax-deferred account, you pay tax when you take the money out. You didn't pay any tax at first. The growth is taxable. And when you leave it to your children will pay tax on that account as well. So we call that the forever taxable account. The Roth IRA or tax-free accounts are a little bit different. You pay tax at first. The money grows inside that account afterwards, tax-free. When you take it out, it's tax-free. And when you leave it to your children, it's tax-free as well. So we call that the forever tax-free account. And a lot of families get pretty excited about the idea of transferring money from an IRA to a Roth IRA. Now, there's many nuances to that. The first step is understanding, does that make sense for me? The second thing, once you understand if it makes sense for you, is how exactly do I go about it? And that's what today's video is going to cover. So let's get into it. So when you're doing a Roth IRA conversion analysis, it's really important to have your entire team involved. It's important to have the financial planner for any financial analyses and management of your accounts and foresight into the investment rate of return and things of that nature. It's also really important to have a good CPA. And I actually recommend you talk to a tax specialist outside myself or talk to a CPA outside of my network to get a really good understanding about your situation and consult them before you make any decision. So with that said, as we talk about the analysis, I have 5 scenarios up here, as you can see in the left-hand side here. If Roth IRA conversions were simple, then you could just convert all the money in 1 year and it would make absolute sense from a tax perspective. However, that's when things can get a little tricky because there's several different scenarios that are often better to convert money from IRA to Roth than simply doing it all in 1 year. In fact, sometimes it makes sense to do it over a couple years or over 10 or 15 years. And there's 3 values we're looking to maximize here. We're looking to maximize legacy value, which is the amount of money you leave when you pass on, your children inherit the account. We're looking to maximize that. We're looking to minimize the total tax to be as low as possible. And we're looking to minimize excess Medicare premiums. Now, for those of you that might be unfamiliar with this, your Medicare, starting when you're 65 and onward, every 2 years it's changed. And it's changed based on the tax year 2 years ago. If you exceeded one of the limits, then your Medicare costs would actually go up. It's called an excess Medicare premium. And I want to include that in this analysis because if you have too much income or too much taxable income, that could increase your Medicare. If your taxable income goes way down, as you'll see, then your Medicare costs also go way down. So that's something to look at too. So here we basically have those 5 scenarios. Again, we have current scenario. This is based on this person not doing anything. No Roth IRA conversions. This is simply the normal trajectory for a lot of retirees that I meet with. Most of them, in fact, follow this trend that I will show you. And I'm going to show you the current scenario before I go any further. Now, this is going to look a lot like your life. Whether you're 70 now, or you're 63 now, or you're 59 now, at some point, you're going to be forced to take something called a required minimum distribution. That is a mandatory withdrawal that you have to take from your IRAs and 401ks and 403bs in the future. And they give you a deadline. And that deadline, as of right now, is 73. When you're 73, you'll have to start taking these things. And you don't have an option. And as you can see, this person goes from not taking anything out of their IRAs, and then eventually when they're 73 and they're postponing it till April the year after they turn 73, so they'll be 74, they're going to be forced to take $66,000 out of their retirement accounts, although they don't need it. $66,000, it's going to become taxable. we look at their other income sources right now, they don't have any pensions. They have some rental income, and then they have Social Security. And because of their taxable income, their Social Security will be taxed as well. Surprisingly, however, if all you had was Social Security on your tax form, you wouldn't pay any tax at all. It's because of other income that your Social Security becomes taxable. So basically, if I'm looking at 73 here, if I go over here to their taxable income will go from averaging about $36,000, $39,000 to being over $100,000, and they don't need it. Well, what happens is their tax bill also goes from $4,000 to $20,000. And then suddenly it's around $20,000 or more for the rest of their retirement. So the total tax they'll pay on their normal retirement trajectory is $509,000. Also important to keep track of the growth of that account. So the IRA, it's growing. It's growing at, we have 5% assumption here. And then again at 74, they start taking them. So you go back to the previous year, 73 years old. You have to go to an IRS table. And it says here at 73 years old, your RMD factor is 26.5. That means I will go to the account value when I'm 73. I will divide it by that number, and that will give me my RMD. Now that RMD, in this scenario, we're assuming that RMD, she doesn't need it, so she's reinvesting it, and she must pay tax, therefore, on any gains or interest or dividends. And that's what we have going on down here in the brokerage account analysis. Because you also have to worry about investment taxes in retirement. As you can see at 74, our first RMD goes in that account. And then the next year, another RMD goes in that account. It's growing. It's producing interest. This is the interest and dividends. And then there's tax that this person's responsible for paying. And so we add that up. So another $103,000 of tax that you'll need to pay. And then there's a legacy value. This is for this person at 90. They'll have about 1.6 in their account. Their children inherit that 1.6, and they're going to be forced to take an RMD, and that's what the amount is here. They can take it out all at once, meaning the 1.5. They can take it out over 5 years. They can take it all out over 10 years, and 10 years is the latest you can push it. So they're taking a little bit out every year. And so the IRA, because it's forever taxable, this person's children will have to pay about $500,000 of tax. But the thing I want to show you here is Medicare. Tracking Medicare as their RMDs and their gross income goes up and up and up, it keeps pushing their Medicare costs up. So eventually, when they're between 85 and 90, their Medicare costs will be about $6,000, $7,000 a year. And then total, that's how we came up with $105,000. So if I go to bottom line results, what do we see here? This is what we see. Total, this person will pay $509,000 of tax, plus their children will pay $500,000 of tax, plus investment taxes, another $103,000, and that brings us to $1.1 billion of tax total. And that is the current scenario. So what we had to do is strategizing, well, if you do a Roth IRA conversion, can we, number one, increase the accumulation value over time because you're not paying taxes as often? Can you, number two, minimize the amount of taxes you pay total over your lifetime? And number three, can we also minimize Medicare costs? And so there's many of options here. One is doing it all in 1 year. One option is doing Roth IRA conversions until you have to begin those required minimum distributions, then you stop. We have it doing it over 10 years and over 15 years. Now, if I go to the rightmost column here, we have the most important numbers in this whole concept. So as you can see, total tax paid while paying any of these numbers on the bottom, it makes a lot more sense than paying this. Medicare 2 makes a lot more sense for all of these except the last one. The gain column, though, is how we track what is the total net yield or gain that you would acquire by doing a Roth IRA conversion. And in this demonstration, it turns out that doing it over 10 years is the most lucrative way. As you can see, $956,000 of gain. That's between Medicare reduction, total tax reduction, plus the account being worth 3.2 versus these other ones, which are less, except for this one, but then the taxes are not as good. So it comes out making sense that doing it over 10 years is the best way, has the best net gain. So if I go to scenario 4 and show you what that looks like, this is what it would look like. Now I've shown you a lot of this already. What I want to demonstrate here is that this person is doing Roth IRA conversions of about $150,000 every year for about 11, 12 years, even past the point where they're taking RMDs. And what basically happens here, it's going to end up, although this isn't a perfect illustration here, it's going to end up that their RMDs are going to be zero. They're going to be in a moderately high tax bracket and then drop into the lowest tax bracket. As you can see here, this person will pay $550,000 in tax compared to $509,000. So this person will pay more tax while they're alive. But the rest of this tax, which is about $600,000 worth of tax, is basically gone here. They'll have about $25,000 of tax that will get eliminated during year-to-year tax planning. So total, they'll pay $576,000 in tax compared to paying over $1 million. And that is from doing Roth IRA conversions over, again, 12 years. So again, it's first, does a Roth IRA conversion make sense for me? That's a basic calculation. But more importantly is, how do I do it in a way that is the most effective? And that's something you definitely want to consult a CPA or a tax specialist on, your financial planner, and make sure that you're capturing the most savings possible from a Medicare perspective and from a tax perspective. With that said, it's always a pleasure breaking down concepts for y'all. If you're a current client of Zenith, or you're looking to become a client, or you're just into education, I really encourage you to subscribe to this video so you get alerted when new ones come out, or to get recommendations on other videos that I've made so you can further your education. Ladies and gentlemen, I'll see you next time.